What if I told you that the world's second largest economy is currently grappling with a ticking time bomb in its real estate market? Yes, you heard it right. China's real estate market, once a driving force of its economic growth, is now facing significant challenges. Falling property sales, a slump in housing prices, and an increasing difficulty in sourcing funding for developers are the talk of the town. We're seeing a slowdown with declining sales in many economies, and China isn't an exception. Economists predict a decline of 15 to 20% in some markets, and the once booming house prices are predicted to come to a halt. Consider Rongxingda Development, a unit of Chinese real estate developer Rise Sun Real Estate. They've recently filed for bankruptcy protection due to dwindling property sales and the increased difficulty in accessing funding. This is not just one isolated incident, but a reflection of the broader issues at play in the Chinese real estate market. So you might be asking yourself, how did we get here? But to fully understand the magnitude of this crisis, we need to delve into the causes. A crisis of this magnitude doesn't happen overnight. It's the result of a series of events and decisions. Let's delve into the root causes that have led to this real estate crisis in China. One key player in this unfolding drama has been the central banks. They've been raising interest rates in an effort to combat inflation, but this action has had an unintended side effect. It's led to falling house prices and declining sales. This is because as the cost of borrowing money increases, people are less likely to take out loans to buy houses, and if houses aren't being bought, prices drop, and sales decline. Adding fuel to this economic fire is the issue of unemployment. Joblessness has been rising, and this has a direct impact on the housing market. People without jobs are unable to afford their mortgage payments, leading to forced sales and foreclosures. This influx of houses on the market further depresses prices, creating a vicious cycle of decline. The crisis in China is also closely tied to the global housing market slowdown. The world is interconnected, and a downturn in one area can ripple out to affect others. The pandemic boom in house prices is ending, and economists are predicting declines of 15 to 20% in some markets. This global slowdown is exacerbating the situation in China, as the country is already seeing falling house prices. The consequences of this crisis extend far beyond China's borders. As the world's second largest economy, any significant disruption in China can have potentially severe global consequences. But that's a story for another time. For now, let's just say that the causes of this crisis are complex, interconnected, and have far-reaching implications. When the world's second largest economy catches a cold, the rest of the world sneezes. This old adage rings particularly true when we consider the potential global impact of China's real estate crisis. China's economic slowdown could have far-reaching effects on the global economy. Its ripples might be felt across trade, investment, and financial markets. You see, China is not an island. It's a crucial cog in the global economic machine, intricately connected to numerous other economies through a complex web of trade relationships and investment channels. So, imagine if China's economy slows down significantly. That could mean less demand for goods and services from other countries, affecting their export revenues. It could lead to decreased Chinese investment in foreign markets, potentially causing a slowdown in these economies as well. Now let's talk about the financial markets. China's real estate crisis could lead to a loss of confidence among international investors, causing stock markets to wobble. It could also trigger a debt crisis, considering that much of the world is heavily indebted to China. In response to the slowdown, Beijing has implemented measures such as cutting taxes and interest rates. However, these actions have not been enough to boost the economy. Investors are skeptical about the government's intervention, with a considerable number believing it will be too little and too late. China's real estate crisis is a stark reminder of the interconnectedness of our global economy. The ripple effects of this crisis could reach far beyond China's borders, potentially leading to a global economic slowdown. In the face of this crisis, the question is not if, but how severe the global consequences will be.